Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of everything the corporate world throws at us like a massive merger about to go down, and what that means for everyone involved today. We are diving deep into a recent filing from Kenvue, Incorporated, a company spun off from Johnson & Johnson, that is currently in the middle of a huge deal to be acquired by Kimberly-Clark Corporation. This filing is essentially an update, a supplement to their previous disclosures, and it's packed with information about the ongoing legal battles and updated financial projections, all stemming from this massive merger. So Kenvue Inc., a company that became its own public entity not too long ago, is going through a significant change. They are set to be acquired by Kimberly-Clark Corporation, a well-known consumer goods giant. This kind of news usually shakes things up, and as you might expect, it is leading to some interesting legal and financial developments that we need to decode. Now, when a big company like this plans a major transaction, it's not uncommon for shareholders to have questions, and sometimes that leads to lawsuits. In this case, Kenvue is facing multiple lawsuits from its shareholders. These lawsuits, filed in different courts like the United States District Court, Eastern District of Wisconsin, the Superior Court of New Jersey, and the Supreme Court of the State of New York, are all generally alleging that Kenvue and its directors have failed to provide all the necessary material information to shareholders about this merger. Basically, the lawsuits claim that important details were left out or misrepresented in the documents shared with investors. It is not just Kenvue shareholders who are suing Kimberly-Clark. The company looking to buy Kenvue is also facing a similar lawsuit from its own shareholders in the Court of Chancery of the state of Delaware. This complaint also claims that the board of directors for Kimberly-Clark breached their fiduciary duties by not disclosing all the material information needed for their stockholders to make a fully informed decision about the merger. These lawsuits are seeking to halt the merger process until proper disclosures are made, and are also asking for legal fees and other costs. Kenvue is putting out this information, this update, to address these legal issues and avoid any delays or negative impacts on the merger. They are essentially saying, look, we're supplementing our previous statements to make sure everyone has more information, and they are doing this to try and keep the deal on track. It's important to note that Kenvue states these updated disclosures are not an admission of fault or materiality, but rather a step to minimize legal costs and distractions. This filing is a supplement to their official joint proxy statement prospectus. Imagine this as an addendum to a contract, providing extra details and clarifications. They are adding new information under sections that already exist, like background of the mergers and opinions of Kenvue's financial advisors. The company is adding details about how they formed a special committee called a Strategic Review Committee back in June of 2025. This committee was made up of 5 board members, and its main job was to look at potential strategic options for Kenvue. They were given the authority to review, analyze, and evaluate any strategic alternatives. Basically, to explore all the possibilities for the company's future, including this merger. This was formed for convenience and not because of any conflicts of interest. They are also clarifying details about their non-disclosure agreement, or NDA, with Kimberly-Clark, or KC as they call them. This NDA was signed on the 16th of August 2025. Importantly, it did not have a don't ask, don't waive provision, but it did have standard standstill clauses. Standstill clauses generally prevent a company from taking certain actions like a hostile takeover for a specific period. This particular agreement did allow for confidential proposals to be made to the board or CEO, and it would automatically end if a definitive transaction agreement was signed with a third party or KC. To read also more detail about the legal counsel involved, Kimberly-Clark hired Gibson, Dunn and Crutcher LLP to help with their investigation into Kenvue's product liability matters. This was especially important because Kenvue's law firm, Kirkland, was also representing Kenvue on existing product liability litigation. The filing clarifies that Kenvue represented less than 1.0% of Kirkland's total revenue in 2025, which is a detail meant to address potential conflicts of interest. Now, let's get into the financial advisors and their opinions. This section talks about the fees and relationships that JP Morgan Securities LLC had with both KC and Kenvue. Over the 2 years preceding their opinion, JP Morgan had provided various investment banking services to both companies. For Kenvue, these services included things like being a joint lead bookrunner on an equity offering in May 2024 and a passive bookrunner on a debt offering in February 2025. For KC, they helped with a credit facility in May 2025. The aggregate fees recognized by JP Morgan from Kenvue were around $24.0 million. And from KC, about $11.0 million. JP Morgan also anticipates receiving fees for providing financing in connection with the merger and holds less than 1% of the common stock of both companies. Then we get to the valuation analyses performed by Kenvue's financial advisors, Centerview Partners LLC. They looked at similar publicly traded companies to estimate Kenvue's value. We see a table here comparing enterprise values and implied enterprise value to estimated future earnings, or EBITDA. For example, Colgate-Palmolive Company had an enterprise value of $70 billion with an implied multiple of 13.5 times its estimated 2026 EBITDA. In comparison, Kenvue's enterprise value was estimated at $36 billion with a multiple of 9.9 times its 2026 EBITDA. Kimberly-Clark, or KC, had an enterprise value of $41 billion with a multiple of 11.2 times its 2026 EBITDA. This comparison shows how Kenvue was valued relative to its peers and the target company. Centerview also calculated a range of implied equity values per S-share for Kenvue based on its estimated 2026 EBITDA. This range came out to be $18.07 to $21.73 per S-share for KC. The analysis yielded a range of $119.14 to $141.25 per S-share. It is important to remember these are just financial analyses and not definitive prices. The discounted cash flow or DCF analysis is another valuation method used. Centerview estimated Kenvue's future free cash flows and then discounted them back to their present value. For Kenvue, this analysis resulted in an implied per S-share equity value range of $23.34 to $28.96. For KC, the DCF analysis provided a range of $136.93 to $167.83 per S-share. These figures help in understanding the potential value of each company based on their projected ability to generate cash over time. They also looked at analyst price targets. Wall Street analysts had price targets for Kenvue ranging from $15 to $24.5 per S-share with a median of $20 for KC. The targets were between $113 and $162 per S-share with a median of $132. By comparing these ranges and considering the cash component of the deal, they derived an implied exchange ratio range, which they then compared to the actual exchange ratio agreed upon in the merger agreement. Goldman Sachs and Company LLC, another financial advisor, also performed a discounted cash flow analysis. For Kenvue standalone, their analysis resulted in an illustrative per-share equity value range of $20.59 to $30.08. This gives us another perspective on Kenvue's intrinsic value. For the pro forma combined company, meaning Kenvue and KC merged, Goldman Sachs' analysis yielded an illustrative present value of the merger consideration, per S-share of Kenvue common stock ranging from $25.82 to $36.36. This is higher than the Kenvue standalone analysis, suggesting potential value creation from the merger. Goldman Sachs also conducted an illustrative present value of future share price analysis for Kenvue standalone. This method looks at projected future share prices and discounts them back to the present. For Kenvue, this analysis resulted in a range of implied present values, per S-share of $15.49 to $28.06. Now, let's talk about the financial projections. Companies often prepare these projections for internal use and for advisors during major transactions like this. Kenvue and Kimberly-Clark have shared various sets of projections, including standalone projections for each company, projections adjusted by the other company's management, and synergy projections, which estimate cost savings and growth opportunities from the merger. Looking at Kimberly-Clark's standalone projections, we can see their revenue is expected to grow from $16.486 million in 2025 to $19.013 million by 2030. Their adjusted EBITDA, which is a measure of operating profit before interest, taxes, depreciation, and amortization, is projected to increase from $3.705 million in 2026 to $4.586 million in 2030. These are the raw numbers, but what they mean is that Casey expects to grow its top-line revenue and its profitability over the next few years. Similarly, Kenvue's standalone projections show revenue growing from $15.448 million in 2026 to $17.847 million in 2030. Their adjusted EBITDA is expected to climb from $3.565 million in 2026 to $4.911 million in 2030. What this tells us is Kenvue also anticipates solid growth in both its sales and its operating profit in the coming years. Then we have the Kenvue Management Adjusted Casey projections. This is where Kenvue Management looked at Kimberly-Clark's numbers and made their own adjustments. Here, Casey's revenue is projected to be $16, $988 million in 2026 and $19, $0.23 million in 2030. Their adjusted EBITDA is seen at $3, $705 million in 2026 and $4, $693 million in 2030. It is interesting to see how the projections can shift depending on whose perspective you are looking at. And finally, the Kenvue Management adjusted KC projections. This section presents Kenvue Management's view on Kimberly-Clark's future financial performance. For 2026, KC's revenue is projected at $16, $988 million, and their adjusted EBITDA at $3. $705 million by 2030, the revenue is expected to reach $19, $0.23 million, with adjusted EBITDA hitting $4, $693 million. The differences in these projections highlight the assumptions made by each company and can influence the perceived value of the deal. This filing is also a reminder of the legal documentation required and the importance of reading all official filings. They emphasize that this report is not a substitute for the full registration statement and joint proxy statement e-prospectus, which contain critical information for investors and stockholders. The document includes a strong cautionary statement about forward-looking statements. These are essentially educated guesses about the future, based on current expectations. They warn that actual results could be very different from what is projected due to numerous risks and uncertainties that are beyond their control. Things like the possibility of the merger agreement being terminated, regulatory approvals not being met, competing offers, difficulties in integrating the two companies, potential litigation, disruptions to business, and various economic and global events like inflation, trade actions, natural disasters, or pandemics could all impact the actual outcomes. They stress that these forward-looking statements are only as of the date of the report and they do not commit to updating them. They also make a point about combined financial information and non-GAAP metrics like adjusted EBITDA and unlevered free cash flow. They explain that projected combined financials are not prepared according to specific pro forma requirements and are for illustrative purposes only. They also caution that non-GAAP measures have limitations and may not be directly comparable to other companies. So, what is the big picture here? Kenvue is in the middle of a massive merger with Kimberly-Clark, and it is facing a barrage of lawsuits from shareholders who feel they are not getting all the information. Kenvue's response is to provide more details and clarifications in this filing, aiming to keep the merger process moving. The financial projections show both companies expecting growth, and the analyses from the financial advisors provide a range of potential values for each company and the combined entity. However, the numerous risk factors and cautionary statements underscore the inherent uncertainty in any large transaction, especially amidst ongoing litigation. Looking at these numbers and the legal challenges, Kenvue seems to be navigating a very complex situation. The projections for standalone growth indicate a healthy business, but the impact of the merger and the integration challenges are significant. The lawsuits, while common, do add a layer of risk and uncertainty. The financial valuations from their advisors give a broad range of what the market might perceive as fair value, but the ultimate outcome will depend on how smoothly this merger progresses and how these legal hurdles are overcome. What are your thoughts on this unfolding situation? Can Kenvue and Kimberly-Clark successfully navigate these lawsuits and integrate their businesses without a hitch? Let us know in the comments below. If you found this breakdown helpful, smash that like button and subscribe to Corporate Decoder for more deep dives into the world of business and finance. And don't forget to join our Discord community linked in the description for more engaging discussions. Thanks for watching, and we'll see you next time.